Welcome to EIS Navigator, the podcast for UK venture capital. I'm your host, Brian Moretta. Today, we continue with our EIS Basics series, and we're talking about how companies can find the right investor or fund for their business. As a reminder, as well as the audio podcast version, you can see a video version on YouTube. And today, I'm delighted to be joined by Michael Theodosiou, who is an investment manager at Symvan Capital. Welcome to the podcast, Michael.
Thanks for having me.
It's absolutely our pleasure. Well, we had your boss, Keelan, way back on episode 79, which was a couple of years ago. So anyone who missed that, do you want to tell us briefly who Symvan are?
Absolutely. So Symvan Capital are an award-winning EIS and VC fund manager. We've been going since 2014 was when the first fund launched, although was in a previous incarnation before that. We are growth technology specialists with a particular focus on business-to-business software. And I suppose in terms of our investment strategy and ethos, we have been described as a boutique firm in that we keep our portfolio pretty small, and we try to be quite hands-on investors with all our companies.
Excellent. So I say you've been raising funds and investing for a decade now. So you've seen quite a few companies coming to you in all sorts of stages. So you're probably well placed that, so we're going to ask this question about how a company chooses the right EIS or VCT manager. And I suppose there's probably a question we should ask before that is, how do companies approach that?
Yeah, I think it's a question that founders absolutely should ask themselves. I think there's a danger of maybe falling prey to this idea that the securing of venture capital funding is sort of a goal in and of itself, and it deserves a sort of pat on the back, but it's not necessarily the right option for everyone, or not necessarily at that particular moment in time for a company. So I think the very first step in terms of preparing for this is having a real serious think about what it is that you want to achieve. The funding conversation should be a means rather than an end. What do I want to achieve in the business? What capital do I need to make that happen? And therefore, how do I go about bringing that in to allow me to hit the targets that I want to hit? Like I say, rather than it just being an end in and of itself. So that really requires a founder or a founding team to sit down and engage with that question of what it is that they want to achieve. And do they need to bring in external investment? And if so, does it need to be from a VC? I think there is something to be said. Maybe I shouldn't be saying this as a VC, but I think there is a lot to be said for bootstrapping on occasion. And actually, even I say that from a VC's perspective, we often quite like to see people who have dug in and done a bit of bootstrapping. It shows a degree of dedication, of seriousness, of an appreciation for the fact that helps de-risk the proposition in what is a very, very high risk market, at least on an individual company basis. So I think the first thing is not to rush into it, to assume that what you want to do is go and scattergun approach every VC that you can find with a sort of a spam email and hope that something hits. Make sure it is what you actually want to do in the first instance, and that you've got a clear idea of what you want that money for. Yeah,
because I think in some sense you are beholden to that venture capital investor, and you have to have an idea, I think, also about the return that they are expecting of venture capital returns. If you think you're just going to double your money after 10 years, that's not really a venture capital type business.
Probably not.
Business, but it's not really a venture capital type business.
Yeah, absolutely. And then that comes back to the idea of making sure that you're clear about what it is that you want your company to achieve and what you think it can achieve, and then marrying that with the expectations and the targets for a venture capital investor coming in. And the same sort of applies to angel investors as well, but maybe to a slightly lesser extent. But the point you made about the expectations that come with investment, it needn't just be in terms of sort of an onerous, presence on your shoulder as a founder that you need to constantly be trying to appease. But I think there is something very fundamental about that moment that any other shareholder really comes on board, but particularly if there's someone who's invested for their shareholding, your role as a founder does shift from it sort of being your own little personal fiefdom into just from a legal perspective, if nothing else, you become the steward of other people's shareholding as a director, as a founder. And you need to kind of go into that with your eyes open, that you are now looking after other people's interests. And it's not just a sort of personal project anymore.
Yeah, absolutely. So if someone's actually crossed that bridge and we haven't put you off yet, maybe it's worth just saying, a little bit about the different types of managers that are out there. Because as you say, there's, I don't know, a couple hundred VCs, I would guess, or something like order in the UK. Order of magnitude bigger if you look at America. They're not all the same.
No, far from it. Even in the relatively small sector of SEIS and EIS, there's a remarkable amount of, almost a dizzying array of variation between fund managers and their approaches. So it may not be what founders necessarily want to hear, but I think the advice I always give is you have to do your homework on this a little bit as a founder. In my experience, I can't think of anyone who has recommended or has a good experience from a VC's perspective of that sort of scattergun approach that I mentioned before. And ultimately from a founder's perspective, totally understandable. And I fully agree with it, that you don't want to be you don't want to get sucked into a very time consuming process and fundraising, just pulling all your focus when what you want to be doing is building a business. Mm-hmm. But actually, I think if you do some homework and you do a bit of research, it means that you can be more targeted and more effective and more efficient when you're going out to market than simply taking a sort of scattergun approach. So I think the first step is to go and do a bit of research. There are plenty of independent assessors and reviewers of products in this space. There's also resources like the EIS Association itself, which has most of its members listed there. And so if you really are coming into it cold, these kinds of places are a perfect place to at least know where to start looking. And then once you've got sort of a list of the right sort of people in the right sort of space, then you can drill a little bit deeper to find out what it is that they do. And a lot of that high level information that I think will be relevant to making your initial decision about who to approach, it needn't be much more than looking on their website.
So that kind of high level information you mentioned there. I think there are some really simple distinguishing characteristics between managers.
Of course. Yeah. So sector is an obvious first port of call, both in terms high level things like, are they a deep tech fund or a software fund or a life sciences fund? That kind of high level distinction is a very obvious thing to ascertain first. And then maybe a little bit more granular on that kind of thing. What specific verticals within those high level sectors do they look at? Are they an insurance tech specialist, or are they a climate focused fund, or whatever it might be? So that really allows you to filter things quite quickly from a high level perspective. Then I think the other very obvious one is the stage that fund operates at. Is it a pre-seed, seed, Series A, Series B fund? Is it SEIS, EIS, VCT or other? That will give you an indication of whether you're the right fit for them and they're the right fit for you. And then after that, there's slightly more granular detail that might be harder to find immediately, but when and how they're deploying as well. Not all funds are raising or deploying all the time. You might not be at the right point in the tax year if it's a tax advantage fund. So making sure that you understand that is also helpful, because there's nothing necessarily wrong with approaching people before you're ready for them, but it requires a different type of approach, I think.
Yes. So we had approaching managers down the list. So you mentioned, when should companies think about approaching a fund manager?
It does depend. I tend to tell companies that you should be getting the ball rolling on a fundraise between 3 and 6 months before you want the actual investment to be met. Obviously, it's a bit of a how long is a piece of string question, because it can be shorter, it can be longer, depending on lots of factors, really, whether you're syndicating and it's part of a larger group of investors or not, the level of complexity, the stage you're at, the size. But I'd say that's a decent assumption to make about how long it will take you. Don't leave it too late, obviously. And certainly you don't want to be fundraising when your back is too up against the wall. From a runway perspective, I always tell companies that the best time to be raising money is when you don't need it, because it just gives you that flexibility and that power, I guess, in the negotiating bit of terms. If you're not desperate for it, it helps. So I'd say give yourself a good buffer, give yourself a good run at it as a founder, give yourself that time to do a bit of the research, like I said, to prepare the information on your side and to allow those conversations to sort of warm up. They're going to take a little while. I know different funds have different approaches to this. Speaking from our approach and our experience at Symvan, we usually take between 2 and 3 months from a first conversation to actually deploying an investment into a company. And I don't think that's sort of massively unrepresentative of a lot of people.
I've seen loads of people, as you can imagine, and yeah, that is fairly typical. There are some that do take a little bit longer. There's some that can do it shorter if they're really keen and they feel the need's there. But yeah.
So I think, giving yourself that time as a founder is important. So, and also take into account the time of year, like I said, depending on when funds are deploying. The lead up to the end of tax year for SEIS and EIS funds is obviously pretty critical, and that can work in a founder's favor. And I would say, again, as long as you have got a clear picture in your own head as a founder of the requirements, what it is that you're looking to raise and what you're using it for, then working backwards from that point to know how much time you're giving yourself to bring in those funds without it killing your momentum if you're already up and running. Or, like I say, getting your runway into a position where it's a little bit squeezed, and then you're kind of panicking, and maybe you're having to accept terms that you'd rather not, or your choices aren't as broad as you hoped they were.
Yeah, and in terms of approaches, I mean, is the best way just send an email, or are there better ways of actually approaching fund managers than just sort of finding something from the website?
Yeah, it can be difficult because fund managers see hundreds and hundreds of decks on a weekly basis, a lot of us. And so finding a way to break through can be difficult. You're right. I think the first port of call should be the company website. A lot of us have sort of a web form that you can put your deck and some short information about yourself and your business into, go into a pipeline processing system, which should cover things. Obviously, more warm introductions are better. Again, speaking about our own pipeline and deal flow process, I'd say one of the sources of deals that has the highest level of conversion are from direct recommendations. But obviously you can't just manufacture those overnight as a founder. But I would say it's helpful to have a look at, if you want an avenue into a warm intro rather than just these cold emails, then looking at the portfolios of the people that you want to approach and maybe trying to reach out to other founders in their portfolio, I tend to find that that's quite a sensible place to start. You can get an unvarnished view of that fund manager. Do they actually do what they say they do on their website, or is it all marketing? You're basically doing a customer reference call, if you like. And if it works, then you might have a much warmer introduction into that fund. Obviously, any other networks that you can do that through can be helpful. See, things like getting onto accelerator or incubator programs can be very helpful as well, because they often make introductions to these, but also it just sort of increases your visibility. So, we have an indication that you've passed muster to some extent before approaching us. But even if you are relying on cold approaches, if you're really struggling to find those warm intros and warm leads, at the very least, like I say, try, and it sounds very sort of, reminds me of the advice I used to get about UCAS forms and personal statements, but do try and tailor it. Don't do a sort of dear team or dear investment team. Try and find someone, speak to them, find out what it is that they invest in and try and speak to that. It goes a long way. When you just see generic emails, it's very difficult to sort of muster the enthusiasm to put them high on your list of the hundreds of decks that you're reviewing on a weekly basis.
And once this is a question of the process. You mentioned some initial filters for managers. What would be, once you're in the process and maybe, if you're lucky enough, you've got 2 or 3 people to compare. How do you start distinguishing between about, which manager might be the best one for you?
Yeah, a really good and important question. And it can be quite a difficult one. Especially if it's your first time as a founder and you haven't really been through this before. You don't necessarily know what sort of market standard terms are, although there are resources to help you with that. I think, at the risk of sounding a bit like a broken record, I think it comes back to that first point I made. The first thing that you need to do is be clear in your own mind what it is that you want. Yes, obviously get advice from others and other founders in particular. And there's obviously plenty of resources on the internet for what market standard might look like, BVCA template documents, these sorts of things. But yeah, I would urge founders to not be swayed overly by others. Even advisors, even lawyers, if you've got to that stage, know what it is that you want and what you want out of it. Because then you can assess whether the funds, say, like you said, you've got 3 term sheets on the table. You can try and optimize for what is meeting your needs and your requirements best. So, obviously, if you're at that stage with term sheets, looking at those terms and understanding what that means, that balance between what you're getting out of it and maybe what sacrifices you're making for that is really important. Obviously, pure financials, fees. Almost all funds charge fees of some kind, and many of them to the investee companies. So what does that look like? Is it market standard? Is it onerous? Are you happy with what it looks like the value you'd be receiving for that actually are? What value add is there, if any? What degree of control does a fund insist on? Again, I'm kind of couching this in quite negative terms because it can just be sort of consent rights and it's protections for their investors. But from a founder's perspective, it's very easy to see that as ceding control to the person that's coming onto your cap table. But what does that look like? What are those scenarios? Is it going to slow you down too much based on what they require you in terms of reporting or the consent matters that they have? So some of that can be quite daunting, especially if you don't have experience of it. But it's very important to get your head around it and understand what that's going to look like. Because we say this to companies all the time. The sort of time horizon that you're expecting to be invested for is maybe upwards of 7 years on average. So you're going to be cheek by jowl probably for quite a long time. So you've got to be comfortable that relationship is going to make sense. There may be what you may want as a founder is something much more hands-off, and there are funds that do that, and it is basically, here's a check and see what you can do with it. But I think even in scenarios like that, they are on your cap table. Like I said, you've got obligations to them. They will have certain consent rights. So it's important to understand what you're getting into, and it's certainly worth taking your time. In the situation that you've painted, having several options on the table, again, a very, very strong position for a founder to find themselves in, because you can really optimize and take that time to decide.
Yeah. And I think the important thing about it is not just about the price, in the sense, there is a temptation to pick the best price, but the term sheets are a lot wider than that. And I think you're right about, hands off. Managers give support, and I think coming back to a customer reference you mentioned, there's some talk about support and the way it works in practice. Sometimes it's better, sometimes and as you say, what's better for one person may not be better for another. If they're more hands-on and you need to I just want someone at the end of the phone if I need to call them.
Exactly. And I think it's actually more relevant these days than it used to be, and maybe because of that, slightly harder for founders, because I certainly think when I sort of started in this industry about a decade ago, that kind of messaging was probably in a minority of that value add component. But I think it's really prevalent now, and I think that's a good thing, because I think it does mean that more fund managers are putting more time and effort and resource other than just finances into their portfolio companies, which in my view is a good thing. But it does mean that from a founder's perspective who's trying to assess the market in the way that we've been discussing, a lot of the time it can all look like much of a muchness. And like you say, some people may talk the talk without walking the walk, or so trying to get under the skin of that is really important. Really important.
Yeah. I think that's definitely right. Any final thoughts?
Not that I can think of. I'm going to think of something very, very, very sage to say after we finish. But at the moment, I can't think of anything else. Okay. So if anyone wants to find out more about what you're doing at Symvan, where should they go? First port of call is the website, www.symvancapital.com, or looking us up on LinkedIn, where we all, fairly regularly put out information about the fund and our portfolio companies. Or, like I said, reach out to any of us individually or any of our portfolio companies. Excellent.
We will put a link in the show notes to your webpage, at least, not all the portfolio companies. Thank you very much for coming on today, Michael. Really
Thanks, Brian.
appreciate your time.
Pleasure.
So for listeners and viewers, as usual, you can get full show notes with links at harmonandco.com/podcast. You can subscribe to the podcast and all good podcast services or through the link in the show notes. And you can obviously follow us on YouTube as well for this series. If you like what you hear, then please tell a friend or colleague. Give us a really favorite podcast app. Give us a thumbs up on YouTube. They're all very welcome. We can be contacted at inquiries@harmonandco.com. Thanks for listening, and we'll be back next week with the next in the EIS Basics series.